So thanks for joining us. This is actually our second to last Rock Summer Fellows session and our last session in the live online classroom. We are super excited to have Matt Reardon here today, who's a partner at Goodwin and works in their business law department. He represents startups and entrepreneurs, among other firms, and he's going to be talking specifically about the first fundraise from a legal perspective with a focus on safes and convertible notes. So we are going to have some interactive portions of this where you'll have an opportunity to ask lots of great questions. So for those of you that don't have your cameras on yet, please do so in the next few minutes. And thank you all, and I will turn it over to Matt to get started.
Great.
Thanks, Matt.
Thank you very much, Emily. And thanks, everybody, for joining today. So as Emily said, I'm a partner at Goodwin here in Boston in the Tech and Life Sciences group. And I work with founders, entrepreneurs, early stage companies, VCs that make investments into early stage companies, and then the companies from formation through exit. And so today we're going to be focusing on the first fundraising, which I think will be particularly relevant to this group. But if you ever have questions about any other stage of the life cycle, feel free to contact me. So the first thing we're going to talk about, so the idea behind this presentation today is focusing on the first fundraising that your company would do. So we'll assume that you've done the hard work of creating your company, coming up with a great business idea, starting to build your business, and getting an investor interested in investing in your company. That's where our presentation starts today. And so as we go through this, feel free to ask questions. I'll kind of take a break after applicable slides so that there's time to ask questions after each topic. And then there'll also be time to ask questions at the end. So don't hesitate to jump in. This will be much more exciting if it's interactive. And also, I want to make sure this is as applicable and useful to you as possible. So make sure we cover anything that you have questions about. So you've done the work of creating a really exciting business, and you have an investor who's interested in investing. And the question is, what are they going to invest into? On this slide here, I have the key types of, the structure that a financing can take. So the first thing is a SAFE. And a SAFE is short for Simple Agreement for Future Equity. And it's a simple document that was created by Y Combinator, which is the famous incubator. And it's really become the most common source of funding, the most common way to do an initial financing in the market. So very likely what you'll see being proposed for your financing is a SAFE. The next thing here is a convertible note. And a convertible note is similar to a SAFE, and it's kind of what preceded the SAFE. The convertible note used to be what people used for their first financing before the SAFE was kind of created. And so we'll talk about the convertible note as well. Another thing is Series C preferred stock or preferred stock. So this is what you think of when you think of a seed round or a Series A round. It's actual new preferred stock that you create. You come up with a valuation of the company. It's sold at a specific price, and it gives the people who purchase it a wide range of rights. And so that is a much more structured and built out type of financing. Frequently these days, that's not the initial financing round. It'll be, many companies now raise SAFEs or convertible notes, and then at a later date do their larger seed round as preferred stock as kind of their second round of funding. I have on this list common stock. It's something that people think, well, wouldn't the simplest thing to do be to just sell my investor some of the common stock that founders have that already exists? And there's a number of reasons why that's typically not a good idea, basically never a good idea. And so I put it on the list just because it's sometimes proposed, but there's a number of reasons why it doesn't really work. And so we're not going to focus on that point. And then the last point here is side letters. And so in addition to SAFE, if you're doing a SAFE, a convertible note, or a preferred stock, frequently individual investors will have side letters which contain rights specific to them that, you know, maybe everyone in your round, all the investors buy the same SAFE, but then individual investors have special side letters they put in place. And we'll cover those as well. So we'll start with convertible notes and SAFEs. This is the meat of the presentation, because these are the most common forms of initial financing that you'll see. So convertible notes. What is a convertible note? It is a loan to your company that converts into equity once you do a priced round. So an investor gives you a loan, it looks like debt, and then when you raise a preferred stock financing, the note converts into that type of preferred stock. And so the key terms of a convertible note are, it is debt. So it has an interest rate, it has a maturity date when you have to pay it back, and it has events of default upon which you have to pay back the note as well. Looks like a standard loan. The times when it converts into equity, into preferred stock, are when you do what's called a qualified financing. So a preferred stock financing that raises to a specific threshold of money raised. When the company, if your company is acquired, it typically either converts into stock or it might just get paid out at a multiple. And it often also converts at the maturity date. So sometimes it has the option such that if it sits outstanding until the loan is due, it might convert into equity. The reason why, so the conversion price of these convertible notes that they convert at in the round is not going to be the same as what your investors in that round pay. The convertible note holders are taking extra risk by funding the company early, and so they get a discount on the conversion price. And there's two main ways that you look at conversion price, the discount. One is just a straight discount. So the convertible note might say, this note, when we do a preferred stock financing, converts into the new preferred stock at 80% of the price that the new investors pay. So a 20% discount. That number could be a 10% discount, a 25, it could be anything. 20 is like the market standard these days. And the other type of discount they could get is what's called a conversion cap. And what that says is you put essentially a valuation on the amount, the price that the note will convert at. So you'd say, this note, regardless of what your company's valuation is in your preferred stock round, will convert as if the valuation of the company is X. So let's say the cap on your note is $20 million. And then you raise the Series seed financing round and your company is actually valued at $30 million. The new investors in that round will pay for the stock as if your valuation is $30 million, but the convertible note will convert as if the value is $20 million. And so they'll get a discount in that way. From the company's perspective, from the founder's perspective, I think it's typically favorable to you to have just a straight discount. That way it's much more predictable what the note will convert at. And the other thing is, one of the huge advantages of a convertible note is that it doesn't have all of the bells and whistles of a preferred stock financing, and it doesn't require you to value the company. And so one of the real benefits of doing a convertible note early in your life cycle is that you don't have to try to figure out a valuation of the company. If you are to do a conversion cap on your note, you're essentially negotiating a valuation and takes out some of the benefit of doing a convertible note early. Some other terms that you sometimes see in a convertible note are what's called an MFN provision, most favored nations. What this gets at is when you issue a convertible note, you could then subsequently issue more convertible notes before you do a preferred stock financing, and you could even issue them on different terms. And so an investor sometimes says, I want to know that if you go out and sell more convertible notes on better terms to someone else, I will get those same terms. So an MFN is a provision that says that note that you've issued to an investor, if you issue out someone else better terms, the initial investor gets those same terms. Sometimes they come with a participation right. So basically the right to be a part of the next financing you do. So instead of just converting into the round, they might have a right to participate in that round. And then the last thing is convertible notes don't come with any, like governance rights attached with them, but sometimes investors will ask for a board seat or a board observer so they have more control over the company. These most favored nations, preemptive rights, and board seat provisions, these aren't, they're not necessarily standard. They're things that are favorable to investors that they'll sometimes ask for. And this will just come down to, what your investor wants and what is important to you to maintain control over when you're issuing the note. There's no real standard form of the convertible note out in the market. So for safes, which we'll get to next, there is a standard form that's available online. And for preferred stock, there's a standard set of forms that are available online as well. There's no market-accepted form of convertible note. And so they are just, each law firm has their own version of this. They're kind of customized for each investment. And so there's typically more negotiation around a convertible note than there is around a safe, because everyone has their own form and kind of looks at them differently, and there's just generally more different provisions to potentially negotiate. So now that we've talked about what a convertible note is, the reason that you would use a convertible note for a financing is that it allows your company to raise money using pretty simple documents, which are fast and affordable to implement. And they're not as fast and affordable to implement as the safe, but they're definitely quicker and easier to put in place than a new class of preferred stock. And you don't really need a lead investor to do a convertible note. You can issue them on a rolling basis. So you could have one small investor who's interested in coming in and buys a note, and then you could just sell more on a rolling basis as you find more investors who are interested in participating. And there's typically not really an incremental cost of issuing them, one after the other. The downsides for founders to using convertible notes is that when compared to a safe, they're much more restrictive on the company and introduce more risk to the company than a safe. And conversely, they provide your investors with more rights and control over the company than a safe typically does. So one of the key points of a convertible note it is debt. And so it has to be repaid at some point unless you convert it in a financing. And so the key point to think about here is if your convertible note has a maturity date and you haven't raised a financing by that date, you're going to have to go back to your investors and ask them to change the terms, because you are very unlikely to still have enough money to repay them. You probably will have used that money to build your business. And so if you have to go back to the investor and they have the right to get repaid and you don't have the money to give them, they'll have a lot of leverage in that situation to potentially renegotiate some of the other terms of the note to be more favorable. So this debt feature and the fact that it needs to be repaid, kind of like the most critical practical piece of that is it gives your investors potential leverage down the line. It incurs interest. So over time, it grows, and when it converts, the convertible note holder will get the benefit of both the money they gave you and all the interest that accrued on it. And so in addition to the discount they'll get upon conversion, they're also getting a benefit of that interest, which just means they'll be able to buy a larger piece of your company when it converts. Because there is a discount to the price at which it converts, the convertible note holder typically gets what we call a liquidation preference overhang. And what this means is the convertible note investor, if they put in, let's say, $1 million, when it converts, it'll convert into more than $1 million of preferred stock. And so they'll have over $1 million of preferred stock. It will have the right to be paid back more than $1 million in distributions, but they won't have paid $1 million. So they're essentially getting this liquidation preference in their preferred stock that they didn't pay for. And so that's kind of a downside of these convertible notes. And then, as mentioned before, they take more time and are more expensive and give the investors more rights than a safe. And so before I advance the slide here, do people have any questions that we should address now? Kenny.
Yeah, I guess what situations have you seen like startups actually issue convertible debt? It just seems disadvantageous for the most part. So I'm just really curious, like where you've actually seen companies actually try to go that route.
Yeah, so I think that left to the company would pretty much always choose to issue a safe. And so this typically comes from investors. And so there are some investors who say, we think that the convertible note gives us more rights, which is true, and we think they're important, and so they'll push for them. Given the choice between using a convertible note or a safe, the company will pretty much always choose to issue a safe. The other piece here is that the convertible note, until about 10 years ago, was the standard form of convertible interest. And so the safe has become extremely popular over the past 10 years or so, but there's still some investors out there who haven't, made that switch over yet. So that's kind of why you'd end up using a convertible note. Now, when we're talking about something that's not an initial financing, so let's say your company's raised a lot of money, it has a business, and you're in between, you've raised the Series A, and you're trying to get to the Series B, and you need bridge funds. Those frequently are structured as a convertible note because convertible notes can be secured, and they do have a preference in being paid a priority over the equity of the company. And so if you're a later stage company that has actual assets, a convertible note can be much better in a practical sense for investors because it can be secured by the assets of the company, such that if the company really did run out of money, the investors could get something back. At the very early stages where the company doesn't have assets, and if it ran out of money, there'd be nothing to kind of distribute or take, then the convertible note doesn't have like all of the same benefits to the investor as it will later in the company's life. I think, okay, Aditya.
Yeah, I'm curious if can a founder use convertible notes to attract banks or strategic companies to invest? Or similar to what you explained, we're trying to build batteries, which are assets. Mm-hmm. And instead of VC, we were thinking, can we get better terms from banks or strategics by using convertible notes?
It may be possible. A bank, some of the investors who make fewer investments may be more comfortable using a convertible note. They may have used it more in the past. On On the other hand, the SAFE is simpler and there's less negotiation. So for a outside investor that doesn't make a lot of investments, they may look at the SAFE as just like more straightforward and easier to put in place. So I think that's going to come down to really a investor by investor preference. But it's certainly possible that they'd be more comfortable with a convertible note.
Got it. But for an investor, a convertible is better than a safe, right?
Yeah, it generally has more rights. Now, a lot of investors think in a very early stage company, the additional rights of a convertible note just aren't that important, but some take a different view.
Thank you.
Do we have another question? Comrade.
I have a question that pertains to really early stage. We're dealing with individual investors, and we're floating around both the idea of convertible notes and safes, but to an individual investor, they're going to make assessments differently than an institution. Could you talk a little bit about pros and cons, or what one might benefit us versus the other in our situation?
Yeah, I think that to the extent that you could use a safe, that's going to be preferable. And the reason I say that is because they're just easier, and there's a standard form out there. So if you have individuals who are interested in understanding the safe, they can go to the Y Combinator website and they can look at it. And it can give people comfort that you're not handing them your complicated agreement that they don't understand. You can say, this is what everyone in the industry uses. I'm not changing it. I'm just presenting you with what is the standard form. And you can go online, take a look at it, and understand it for yourself. So I think that a safe is easier to put in place and probably easier for just an individual investor to understand. It's also easier to maintain and easier to convert and better for the company. And so to someone who doesn't have a strong preference, I think that you would suggest a safe. And you can say it's better for everyone because ultimately everyone wants this company to do really well, and the safe puts us in the best position to do that.
Okay. If I may follow up, just as a devil's advocate position, one way we're thinking about the convertible note is similar to a DTIA, where we have some physical product that would have value as an asset. And so maybe on a convertible note, we can say, yeah, you get some, preference in the pecking order, but now we're going to give up less equity. There's a lower discount for you on equity. So we get to maintain more control in our cap table as our, ownership of the company. Is that a negotiation that could, you've seen happen or is common?
I don't know that that's like a super common approach, but there's no reason it couldn't work. As in, if you can get them to invest in more favorable terms on a convertible note versus a safe, for example, if they'd be willing to take a smaller discount, that could be a good approach. Oh, Grace.
On that point, so as we saw that there's actually the three types of safe. You have the valuation cap, no discount, no valuation cap, and you mentioned about the MFN. Could you kind of walk through those really quick, because these are going to be some of the most common documents we might see as early founders? Which ones are more favorable to founders in which situations?
Definitely. And so I will definitely get to that when we get to those slides, and that'll be an in-depth discussion that will cover each of those forms.
Awesome, thank you.
Okay. So let's move on to a safe. So here, as mentioned, the safe is the most common form of early stage financing in the market right now. I would say that most early stage companies that I work with now are getting funded on a safe before they do a preferred stock round. And that is just the standard kind of like pathway to financing early stage companies at this point. in the tech and life sciences industries. And so what we've talked about the general form of a convertible note. And so the idea of an instrument you sell to an investor that then converts into equity in the future, a SAFE is the same idea as that, but critically, it's not debt. It's just a contract to issue the investor preferred stock in the future. So the big differences in a SAFE from a convertible note are that there's no interest rate, there's no maturity date, and so that no maturity date thing is key. Because as I mentioned before, maturity date can shift leverage from you to the investor pretty significantly in the future. The form of SAFE on Y Combinator's website, and as Grace mentioned, there's a couple different forms, but none of them have this qualified financing threshold concept. And so I mentioned it before on the convertible note, but we can dig in a little more now. The general idea for a convertible note is when it's issued, in order for it to convert into equity, certain conditions need to be met. So those are usually that it needs to be a financing in which the company raises a threshold amount of cash, let's say $3 million. The idea behind that is that if an investor bought a convertible note and it would convert into equity in like a very, very small financing, one way that you could get that convertible note off of your, out of your cap table is to just do a tiny little financing. Let's say you raise $100 on pretty bad terms so that the note converts into some kind of like not very good preferred stock. And then after that, you do a real financing where the investor buys regular preferred stock. And so the investors typically put in this threshold, whatever, depending on the stage of your company, it could be different amounts, to ensure that when their note converts into preferred stock, it's converting into preferred stock that's real enough and negotiated enough that the new investor is willing to put a lot of money into the company to buy it. The SAFE form on Y Combinator's site doesn't have this qualified financing threshold. And so what that really means is there's not like a threshold at which you can't, like no one will invest in a company that has a convertible note sitting out there that hasn't converted, because then it's still debt and you'll have to pay it back. So putting that qualified financing threshold in the document means that in order to raise the next equity round, you really need to raise at least X dollars. The SAFE doesn't include that. And so it means that it's much easier to do a preferred stock financing that doesn't necessarily reach a pre-negotiated level of proceeds. So the SAFE makes it easier for the company to go out and raise that next round. The note I've put here is that now some investors are starting to just modify the Y Combinator form to put in a qualifying threshold amount. And so when you see the SAFE online, it doesn't have it, but some investors, once you get into the negotiation, do ask for it. And so it's becoming a more common term to be in a SAFE. So as I've mentioned before, the SAFE that's on Y Combinator's site, it's standard. Everyone uses it. Most people, to the extent it's modified, it's very surgical modifications. And so it can be put in place very quickly and without a lot of negotiation or expenses. And so getting to Grace's question, if you go to Y Combinator's site, there are 3 forms of SAFE. And most of their terms are the same, but what differs in them is how the discount works. And so we talked about discounts with the convertible note. The SAFE has the same general ideas. There is a form that has a conversion valuation cap and no discount. There's a form that has a straight discount, like 20% discount and no conversion cap. There's a form that has no cap and no discount, but has an MFN. And the idea behind that one is you can put it in place super easily and quickly, and negotiate almost nothing. And then when you raise another SAFE that's negotiated a little bit more, if you put discount terms into it, then the initial investor then gets those terms. And then the fourth one I've put here is cap and discount. And so Y Combinator site used to have a form that had a cap and a discount. They removed that form, and so it's not published anymore, but it's still used. So people still have their own little modified form of it, and it's pretty common. So all of these flavors are pretty well represented in the market. Any of these are standard ways to approach the discount in a SAFE. And then the last thing I'll say about the discount that makes this different than a convertible note is I mentioned with the convertible note, frequently when they convert, they have this free liquidation preference where their liquidation preference in the preferred stock is greater than the amount they actually invested in the company. The SAFE is set up, the form of SAFE is set up such that when it converts into a security that is exactly the same as what the new money investors buy, but it doesn't include the extra liquidation preference. So the SAFE form has the benefit to founders of not giving the investor additional liquidation preference beyond the amount of money they paid that they invested into the company. Okay, so on these kind of basic points, do we have questions? And it looks like Chris has a question.
Yeah, can you explain that again, the shadow preferred stock? So basically, the SAFE converts at the discount rate, and then it would not get liquidation preference upon a future liquidation of the company, whereas the actual priced preference would get that liquidation preference. Is that right?
So it does. So the SAFE will convert into preferred stock that has a liquidation preference, but the amount of the liquidation preference will be the amount that the person invested on the SAFE. So the SAFE buys stock at a discount, so they get more stock for their money, but they don't get the additional liquidation preference. So let's say you had a convertible note and you had a SAFE, and the convertible note converts at a 20% discount, but gets both this and the SAFE converts at a 20% discount. Both of them will get the same number of shares, but the SAFE shares will have 20% less liquidation preference than those convertible note shares that converted. So basically, you get the same number of shares, but it's a question of what the liquidation preference of each individual share in the company is. And so the SAFE shares will have a lower liquidation preference than the convertible note shares would, if that makes sense.
Yeah, it does. Thank you.
Drew.
I had a quick question about, do you see any common mistakes or maybe risks associated with considering multiple safes at the same time? We've had a few investors over the last several months have proposed just pretty small investments or safes, and I wanted to just see if there was a risk associated with considering multiple at the same time, or if we should just focus in on one that we think has the best terms and then go from there.
Yeah. So I think that's a great question, and it anticipates a point later on this slide, which is basically, to the extent that you can issue safes that all have the same terms, that's going to be ideal. And for this reason, if you have safes with different discounts that are going to convert at different prices, then when they convert, what you're going to end up with is a cap table where you have, let's say your next round is Series A. You're going to have the Series A stock that your new money investors buy, and then each of the safes that converts at a different price is going to convert into its own type. So like its own type of Series A stock, like Series A1, Series A2, Series A3, because as we were mentioning before, they'll each have a different price, a liquidation, like a different liquidation preference per share. And so you'll have a cap table that has Series A, Series A1, Series A2, et cetera, for each of the different conversion prices. Now, I'll say this is extremely common to see in venture-backed companies. It's really common to see companies that their Series A round or Series Seed, whatever you call it, has a number of sub-series to it. So you'd be in good company. At the same time, it creates a more complicated cap table, and in certain types of transactions, it can create some complexity and some requirements to get additional like series votes. So to the extent you can avoid it, that's ideal. But at the end of the day, it's common to have that situation. And if it allows you to raise money on better terms, then it's a risk that founders generally do take. Okay, let's see. Next slide. Okay. So, key negotiation points. One thing, so I just talked about how there's like 3 forms of safe that are on Y Combinator's website. And then there's a 4th form of safe that some people use but isn't on their site. So then let's go even further back into history. There used to be a different form of safe entirely that was called the pre-money safe. And basically what that did was conceptually it treated each time. So one of the benefits to issuing safes is what we were getting at with Drew's question, which is that you can issue a safe and then just, issue more and do lots of iterative fundraising before your preferred stock financing. So the pre-money safe back that used to be on Y Combinator's site, which is not anymore, treated each safe that you raised as kind of its own little financing round. And so if you issued a safe on day 1, and then you issued a safe on day 2, the safe that you issued on day 2 would kind of dilute the ownership of safe 1. So they were treated as separate kind of tranches of investment that diluted previous investments on the safe. The new post-money safe that is on Y Combinator's website now treats all safes that you raise as one single round, even if they have different prices. So none of them dilute each other, and they ultimately get diluted in ownership when you raise a preferred stock financing. And we'll talk about some of the benefits of these 2 approaches. What I'll say is it's useful to know this because in some ways, those old pre-money safe forms can be better for founders. But at the same time, they don't exist on the published site anymore. And so they are definitely not, the default is to use what's on the site, which is the post-money safe. And most investors are going to want to use that. So some key points of negotiation when you're talking to an investor would be, if you're going to do a pre-money or post-money safe, most of the time it's post-money, but on the next slide we'll talk about the difference between those 2. Whether you're going to have a valuation cap or a discount or both. So Similar to the convertible note, I think that it's generally better for founders to just have a discount rather than a cap. The discount is just much easier to anticipate what the price in the next round will be, and it's much less likely that you'll have the unintended consequence of potentially raising your next round at a much higher valuation than you would have expected, and in which case you'd be giving those early investors who bought safes a huge discount that you may not have anticipated. Adding the qualified financing conversion requirement is a negotiation point. As I mentioned before, if you can keep it out, that's great. Makes it easier to raise your next, your preferred stock financing. If an investor is really requiring that you put in a qualified financing conversion requirement, it's not unreasonable. And the way to think about it is just like, what is the minimum amount you think you would raise in the next financing, and trying to set the qualified financing threshold as close to that kind of minimum viable financing as possible. Another point is a change of control premium or multiple. So this is a key point in that when an investor buys a safe or a convertible note, they're buying it as an investment in the future of your company. They want it to convert into preferred stock. They're thinking that your company is going to grow, they're going to hold preferred stock and benefit in the growth of your company. If your company is sold before the note or a safe converts, that's not what an investor would be excited about or want. Basically, instead of getting some huge multiple on the growth of your company, they're just going to get their money back. And so safes, so convertible notes typically include what's called the liquidation multiple, which might say, if you sell the company before this converts, the investor gets 2 times what they invested or 3 times what they invested. A safe, the published form doesn't have this construction. The published form, if a safe is outstanding when the company is sold, then they get their money back. And so some investors will negotiate for some type of way of getting a better outcome upon a sale, early sale of the company, whether that's a multiple or whether that is they will be treated as common stock in the sale, such that they're basically treated as though they're founders. And often there's a mechanic for like the price at which they would have to buy that common stock. But the key point here is that investors frequently are going to try to negotiate for some way that if your company is sold before they convert into preferred stock, to get something back better than just a return of the money they put into your company. And then the last point here is side letters, which I mentioned at the very beginning of this presentation. Y Combinator's website has a simple side letter, a pro rata rights side letter, which says that if you issue additional safes, they have the right to purchase those pro rata. And in the financing round, the preferred stock round, they have the right to participate in that round. And so investors often ask for that, and it's a standard form on the website, so that they can have more exposure to the company. If they have a chance to put more money into the company. Typically, companies don't resist this too much. So it's a pretty standard provision of safe financings. And VC investors frequently have what's called a management rights letter, which is something they need under tax law, depending on who their limited partners are. And basically, the management rights letter, generally the standard form says that they have the right to meet with the management of the company, ask questions, and get certain information about the company. And those are just not heavily negotiated because they're required for VCs to have. So if you get a management rights letter from a VC, the main thing to do is just to check that it actually matches what VCs need. And the way you can do that is by going to the National Venture Capital Association's website. It's nvca.org. And on there, they have a standard form of management rights letter that's used in the industry. And so you can go to nvca.org, look at the form management rights letter, and just see if what the investor has presented to you matches the standard form. And so before we go on to the next slide, Chris.
Yeah, you had mentioned side letters for convertible notes could include board seats or board observer seats. Is that true as well for safes? And I was curious how common that is.
It's definitely could. So safes could have that same provision in them. You see it quite infrequently. Typically, safe investors, the general idea with these very early stage safe investments is a lot of times they're not particularly large. The idea is that there will be a number of them that will be sold iteratively. And often you don't have like a lead investor. And so a lot of times these investors are not asking for really any governance rights. Basically what they want is to get into the company early so that when you do a preferred stock financing, they get exposure to that preferred stock financing and they get a discount, but in some ways they just get their foot in the door early so they ensure that they get an allocation in the round. So it's relatively uncommon to see side letters in the safe context that ask for governance rights, but it's not unheard of, and certainly asking for like a board observer is more common than asking for a seat on the board. So you definitely see times when they say, we want to at least be able to come to your board meetings. In many cases, that's not a huge benefit because a lot of early stage companies that are raising safes, the board might just be one founder and might hold board meetings very infrequently, or it might be two. So there could be limited utility to having a board seat or a board observer, but it kind of depends on the company, and sometimes investors do ask for them. Kenny.
On the topic on the multiple and liquidation preferences, I have heard that you should never ever accept anything that isn't 1x non-participating. What are situations where you have seen, like in terms of the negotiation, like I imagine that would change if like the company is in distress. I'm just very curious what other situations you might see something that's not 1x non-participating.
Yeah, so you're thinking once you do your preferred stock financing and you're negotiating the terms of the preferred stock, if it's your Series C or your Series A, what are situations where you would see either participating preferred stock or a non-1x liquidation multiple? And you're correct that it's uncommon. And so I would say it's particularly uncommon to see those terms in an early stage company. The times that you often see those terms is when the company has raised money in the past and is now having a difficult time raising more and is looking for new options for kind of keeping the company afloat. You typically see terms like that when the company has very little leverage to negotiate the terms of a financing. So having a multiple on liquidation preference is basically extra downside protection for the investors, and it gives them liquidation preference in excess of what they paid. And so basically that's protection for them, that if there's a sale of the company that isn't a home run, that doesn't result in everyone being treated as common stock and just getting a pro rata portion of the company, that they will get more proceeds before the common gets anything. The participating preferred stock versus non-participating preferred stock, it does somewhat of the same thing. And a big issue with it for founders and for early investors is that once it gets into your documents, so let's say your Series A is participating preferred stock, Series B will also be participating, C, D, E, whatever, on down the line. And so that can really cut back on any upside for the founders and the holders of common stock, but also it can really cut back on the, what the early stage investors get. And so definitely the advice you got there is good, because it's very difficult to continue to raise funds once you have a provision like that in your documents. Typically, that's an option of last resort for founders. Any other questions before we move to the next slide? So safes, these founder considerations. So as I mentioned, there was an old form of safe called the pre-money safe that has disappeared from Y Combinator's website, and you don't see it very much in the market anymore, but it does still exist. And as I mentioned, in the pre-money safe, each subsequent safe that you issue looks like its own little round, and it dilutes the person who invested before. And in a post-money safe, all of the safes are treated as one round. So what does that mean in practice? It means when you issue pre-money safes, there's no way to know the percentage of the company that safe investor will own compared to other safe holders. And so for the investor, that is potentially a big problem, because when they're kind of doing their math and saying, here's how much of the company I think I'm going to own when this converts, they don't really know, because they don't know how many more safes you're going to issue afterwards that might dilute them. For a post-money safe, everyone's treated the same. And so a safe holder who buys a safe with a conversion cap, they know how much of the company they'll own when their safe converts before the Series A investor comes in. So basically, if you think of the Series A as kind of two steps, there's the first step where all of the safes convert, and they each own a chunk of the company, and then the Series A investor comes in and dilutes both those safe holders and the common stock. But in the post-money safe, the investors at least know how much of the company they'll own before everyone gets diluted by the Series A. And so the post-money safe provides everyone with more certainty over what percentage of the company the safes will convert into. The pre-money safe, the benefit is that it could result in the common stock, the founder team, holding on to a bit more of the company when the safes all convert. And so I think there are benefits to founders of using the pre-money safe. It's a little bit more complicated, and investors frequently are resistant to it, so it happens infrequently, but it can result in the founder ultimately owning more of the company after this initial financing round. So that's one consideration. Another consideration that we mentioned with Drew's question was trying to stick to consistent terms, if possible, as you raise multiple notes or safes. Because as we mentioned, if they have different conversion prices, they all convert into different types of preferred stock once you do the financing, which can be more complicated and can also have some additional restrictions on the company in certain types of transactions in the future. A question is your fundraising goal, and this is tied to the next one, which is how do you track your convertible notes or safes? And so typically when you create your cap table, you look at, it just is a lot of cap tables just show how much stock has been issued and how much each stockholder owns. So you might create an early stage cap table, and let's say you have a couple co-founders, and it will just show a line with how many shares you hold, how many shares your co-founder holds, and what percentage of the company you own. And maybe you even then create an option pool and issue options to people, and it will show how much they own. If you issue safes or convertible notes, they typically don't show up in that cap table. It will still look like you own, X percent of your company, even though you've made a commitment to issue additional shares in the future. You don't really necessarily continue to own that amount. And a lot of times it's hard to, if you just keep seeing that cap table that shows, oh, I own 35% of the company, it's not super clear that actually you've already sold another chunk of the company. And so one thing I recommend is when founders start issuing convertible notes and safes, is that you at least try to model out in some scenarios how much the company you'll hold after you do a funding. And that can be really instructive to show what your real ownership of the company is. And there's different ways to do that. You can do simple math. If you're on Carta, which is kind of a cap table management software program, they have basically a calculator that can help you calculate what you will own based on certain parameters after a financing. And if you're working with an attorney, you can have them help you come up with kind of a model for what your cap table will look like after there's a conversion event. And so that kind of ties into your fundraising goals and how much should you raise. It's hard to really make that decision if you don't know the effect of raising these funds. If you don't know how much you're diluting your ownership in the company ultimately, it's hard to know exactly how much to raise, because that's always going to be a trade-off, is how much dilution should we take versus how much we're raising. So creating that calculator, creating that model can really help you negotiate and determine how much you need to raise. And with fundraising goals, what I usually say is most things take more money than you expect and take longer than you expect. So getting to the inflection point where you can raise your Series A usually takes more time and money than you predict. And so, companies don't go out of business because they raised too much. They typically go out of business because they've raised too little. And so in thinking about how much you should raise, definitely build that model, and then assume that getting to the Series A is going to take more time and money than you predict, and kind of set your fundraising goals accordingly. And I think that's the last slide. So now, do people have questions about anything in this deck that we didn't cover, or any other elements of the fundraising process? Grace.
Yeah, I would just love to know, since you've obviously been through so many of these negotiations, what are the most common mistakes that you see founders have when they enter negotiations? And then kind of related to that, the main difference between first time and second time founders.
Yeah, that's an excellent question. So I think a few things that founders, a common mistake is trying to kind of overcomplicate things. So the simpler you can keep everything, the more standardized you can keep everything, the better. No future investor or investor is going to look at your company and see the interesting structure you use to raise money and think that is a reason to invest. They're purely just going to look at your business and you and the strength of your team and your technology to make their decision. So anything that's off market or non-standard in your fundraising terms will be seen as something they need to get comfortable with, not as a kind of like feature of your company that makes investing more interesting. And also keeping it simple and standardized can help you avoid unintended consequences and complexity in the future. So I talked about, some of how side letters can exist, and they can have investor-specific provisions. The simpler you can keep those, the lighter and the fewer of those you can have, the better. And part of that is because when you issue safes and convertible notes, they typically say that all of the safes can be amended if a majority of the safe holders agree to amend them. So basically, you issue a bunch of safes, and then you don't need every single person you've issued a safe to agree to changes to their safe. If you issue a side letter or special terms for an individual investor, suddenly you won't be able to amend that without their approval. So you have someone out there who has an individual right to keep you from doing certain things. And from a founder's perspective, you always want to avoid giving individuals, investors, the ability to stop you from doing something. Much better to have a class vote where if you have 50% of investors want to do something, you can amend the notes. That way, if you have a couple large safe holders who are very supportive of your Series A, so they can convert into it, you don't have one small investor who you gave a special right to, who can say have some hold up value, and you either taking that right away or converting the notes, etc. So I would say keeping things as simple as possible and avoiding bells and whistles as much as possible is generally the most preferable approach. And I think a big difference between first-time founders and seasoned founders, in many ways, is just the ease of raising funds. And so the most attractive thing to many investors is a history of making money for other investors or them. So once you have had a successful venture that has created a lot of returns for investors, that's frequently the number one thing that investors will use when they're evaluating your company and your team. And so usually a founder who has had success in the past the fundraising path is frequently much easier the second time around. Great.
Thank you. I just wanted to follow up real quick. And when you say easier also, yes, both raising funds, but also the negotiation, if the point is to try to keep it simple and standard as possible, do you also find that seasoned founders have much better terms as well? Or it's just that you just get more investors? I wanted to clarify that difference.
Yeah, no, that's a good point. I think it's more investors and better terms because they would see less risk in your venture. Now, what I'll say is that the safe doesn't have too much to negotiate, and that's one of the great things about it, is that the safe, if you just pull it off the Y Combinator site, it has the things we've talked about, which is should you use the pre-money or the post-money form? Is there a way that you can use just the straight discount form instead of the conversion cap, which would be great if possible? And then there's the negotiation around what the discount will be. But the discount is usually in a pretty tight band. 20% is market standard. And then sometimes you see 25% if this company seems a little riskier. Maybe you'll see 15% if it seems less risky. Maybe even 90%, a 10% discount if it seems like the fundraising is pretty imminent. And so there's little risk of it not occurring. But typically with the safe, most of your negotiation is in a relatively bounded way. And so the key things there are kind of like, focusing on the most important things in the safe, trying to stick with the form as much as possible, and then pushing for the things that are important, like a discount instead of a cap, and trying to push for a smaller discount. Any other questions?
All right. Well, if folks don't have any additional questions, I just want to say thank you so much.
Seems like we might have another question here.
Oh, good.
Sorry.
Oh, no problem.
I will just. I just wanted to hear some do you have anecdotal stories of where just maybe 3 different case studies on founders went through negotiations, or just curious on either hearing stories where it how the negotiation impacted them down the line in ways they hadn't foreseen, but any stories that stick out to you.
Yeah, no, that's a great question. So I think that I'm trying to think of some good examples of how terms in these notes had big impact on the company down the line. And I think that the clearest way to think about this is kind of the SAFE having made it much easier for companies to raise funds. And so companies that used to have to raise a preferred stock financing as the initial financing, it took significantly more negotiation and expense to raise the initial round. Whereas now we're seeing much more very early stage founders being able to raise the money necessary to start their business. And so anecdotally, my founders, many of them are able to raise money and start working on start hiring, start working on more expensive technology, start working with attorneys much earlier, because the ability to raise funds now very quickly and easily is just much greater. And so I think a big difference is that now we're seeing the ability of founders to raise cash and start their business much earlier, and then go into Series A negotiations on better terms, because they already have the cash to run the business, and raising that priced round isn't as urgent. So I think the way that this plays out down the line is that founders are going into conversations with VCs and with sources of capital that are willing to write a bigger check and buy into the company on better terms. Those negotiations are shifted a little bit towards the founder, because they're going in with money in the bank account and the beginnings of a product and a team in a way that they weren't able to do in the past. So I think that's how the safe, being able to raise money on a safe, understanding it and proposing it early on can really help the company's trajectory. And then comparing the safe to the convertible note, I definitely have been in the situation a number of times where a company's gotten to the end of the maturity date in a convertible note and has to go back and ask for an amendment to it. And that can be a difficult conversation and can really shift the leverage of the discussions. And so firsthand, I've definitely seen how the SAFE form, which is not debt and does not come due, can alter the trajectory of an early stage company's development by basically not creating that leverage point for investors.
That's great. I just have like truly one more. Obviously, everybody else. I'm sorry. For this kind of going back to Conrad's earlier question on like individual investors. So if like let's say angels or friends and family raising, I think that's what they call that earlier stage, are potentially interested in investing. Do you normally see founders still come to lawyers and to discuss and finalize that? And is that required, or is like using the YC agreement pretty standard even with like family and friends and angel investing?
Yeah, so for very early stage fundraisers like that, a lot of times people don't work with an attorney. They use the YC forms. One thing I'll say is that when raising money from friends and family, whenever you sell securities, you need to have an exemption from registration, and you can sell securities to accredited investors, but you can't sell. Basically, your investors need to meet a certain threshold in order for you to be able to sell them the SAFE. And so ensuring that the friends and family that you're raising money from are accredited investors is an important step of the process. And it's important for, I would say, like 2 main reasons. One of them is the kind of like legalese reason, which is that technically, or not technically, if you sell the securities to an unaccredited investor, it's a violation of securities laws. I'm not saying that you're going to, end up in prison, but it's not not ideal for your company. The kind of more practical impact is that in the future, when other larger investors are doing diligence on your company, they'll see that you've issued shares or securities to an unaccredited investor in the past, and that can be a risk to them in putting money into the company. And so it can be a hurdle to raising more money from more sophisticated investors.
Great, thank you so much.
No problem. Any other questions about this topic? Early stage companies in general? Chris?
Yeah, on the point of accreditation, I thought there were situations where you were able to raise from a small pool of non-accredited investors. Is that not true? Or do they always have to be accredited? Or I thought there was some exception that was provided
so
for.
There are some exceptions. One of them is for founders. So when the company issues securities to founders, there's an exemption there. You don't have to be an accredited investor if you're one of the founders. There are certain ways to issue stock and securities to unaccredited investors that involve typically a significant amount of process and disclosure. And so there are basically like crowdfunding regulations. I find that they're pretty infrequently used because the costs and complexities of using those typically or frequently is not justified by kind of the amount that's raised. But in short, there are ways to raise money from unaccredited investors using certain crowdfunding regulations, but it is not particularly prevalent in kind of like the early stage market by companies that think that they're subsequently going to raise money from larger investors. It's more frequently used in other industries or for companies where, a lot of this discussion has been assuming that you're starting a company that's going to raise money from VCs over subsequent rounds and like maybe do an IPO. And the crowdfunding regulations, in my experience, just are less frequently used for companies on that track. Seems like we've addressed everyone's questions. So it was great to talk to everyone today. I hope this presentation was helpful to you. I think your questions were excellent and showed that you're really thinking about this fundraising process in the right way. And if you have more questions as you get more into the process, either about safes and convertible notes or just about other elements of financing your business and growing it, I'm always happy to discuss. I've worked with a number of your peers and alumni of this very program, and so feel free to reach out to me, and I hope that all of you have an excellent rest of the summer and great success in your ventures.
And thank you so much, Matt, for taking the time to do this session for our students. This was awesome. And thanks, everyone, for your participation. Have a great rest of your day. Bye.